Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's session. Today we're going to be talking about blue chip investing. So focusing on those more well-established, well-known companies that bring stability to your portfolio in times of market volatility and higher inflation like we're seeing today. So we'll look at how quality and dividend ETF approaches to investing can be effective tools to gain this exposure. Just as a reminder, today we are not providing you any advice or investment recommendations. Today's episode, like all of our episodes, is about providing education around investing and around using ETFs for investors who are really just looking to take charge of their own portfolios. With me today is my colleague, Alfred Lee, Portfolio Manager with BMO ETFs and Investment Strategist. Thanks for joining me again today, Alfred.
Good to be here. Thanks for having me.
Before we get started, just a reminder to check out our YouTube channel to watch any episodes that you may have missed. Remember, please hit subscribe so that you're notified as future episodes go live. Now, being the first episode of the month, I wanted to look back at August flows to give you some insights into what investors are doing in the markets today. So last month, we had 1.4 billion in new assets coming into Canadian ETFs. The most popular segment was definitely the cash alternative segment, which attracted 589 million. That was definitely the highest among all the fixed income categories, which otherwise suffered outflows. We also saw outflows in the commodity and crypto ETF space. And then I thought it was interesting as well from a geography perspective, a lot was going into Canadian equities last month. Now, I couldn't leave this out. It was a tough choice, but I had to include this chart too as part of the update. This is from Bloomberg, and I thought it went well with our discussion today. It shows that investors have been buying record amounts of dividend-focused ETFs this year already, we have 4 months to go. So investors are flocking into these high-quality dividend payers, these blue chip companies. So we're going to discuss more about that today. So let's get started. To set the stage, Alfred, can you provide us with a refresher in terms of what a factor is and what are a couple factors we should be looking at to gain blue chip exposure?
Sure. So factor investing to me basically is, it fills that gap between traditional active investing and traditional passive investing. I think, over the last 10 to 15 years, a lot of investors have come to realize that when you look at, traditional indexing, so, traditional market cap weighted products or indexes, investing isn't necessarily a one size fits all strategy where, certain investors want the portfolios in their stock side of their portfolio to deliver certain characteristics. So, for example, I think, dividends is a good one where, investors may want higher income or higher dividends than what the market or traditional market cap weighted index may offer. Low volatility is another one that tends to be very familiar or very popular with a lot of Canadian investors, given that the TSX tends to be more cyclical in nature. Quality is also one of my favorites as well because it focuses on companies that have strong balance sheets, tend to be blue chip companies, leaders in their respective fields and have competitive advantages as well. But as you can see from this illustration over here, there's a number of different factors that ETFs offer. But I would say ETFs didn't invent factors. Factors were definitely around before ETFs, but ETFs have definitely made factor investing a lot more popular and brought it into the mainstream, I would say.
For sure, and I like this image that just shows sort of the risk profile or spectrum of all the different factors, and you can definitely see that quality and dividends are going to provide you that more stable return stream. Building off this, as we start our discussion around dividend and quality factors, how do these factors generally perform across market cycles? And I think on the next slide, we have one specific to inflationary periods. So maybe you can touch on the general performance of these factors.
Sure. So, very similar to sector-based investing, different factors can outperform and underperform at different parts of the economic cycle. So I think the last chart that we saw was a good illustration of that, where, things to the left side of the market cap weighted index, so things that tend to be more defensive in nature, tend to perform well during, when the economy starts to contract. So during recessionary periods, at the market bottom as well. But then when the market starts to expand, and as we see more economic growth, things that with higher risk tend to outperform. So things like momentum that we didn't really discuss, but things like size as well. So things like mid caps and small caps tend to outperform, as we saw in 2020 coming out of COVID. And last but not least, we also have value as well. Value tends to outperform coming off the market bottom, just because a lot of those companies which were priced for slower growth, once you have that economic backdrop start repricing for economic growth, these stocks are going to reprice a lot quicker. You brought up a good point in terms of inflation, because typically when we think about economic cycles, we think about as I mentioned, the economic contraction, market bottom, economic expansion in the market top. But I think this recession has been very different, where we're dealing with inflation right now. That's the primary concern. So moving over to the next slide, this is a good illustration of that, because I think we haven't really seen inflation since I think the late 1970s, early 80s, and having a good understanding in terms of how factors perform in those different inflationary regimes is very important. So MSCI put this data together for us, where they looked at the different factors that I mentioned and how they performed historically based on different inflationary regimes. So as you can see over here, momentum, quality, dividends, and minimum volatility, which is another name for low volatility, they tended to perform well in inflationary environments. But obviously, every environment is going to be very different. Every inflationary regime is going to be a little bit different as well. But typically in the past, these are the ones that typically have outperformed.
Yeah, I think with quality, especially, these are the really well-known, well-established companies. They're better positioned to pass on their costs to the end consumer, right? So they've definitely benefited from that as well. All right, so let's look at the quality factor and dive a little bit deeper here. Can you walk us through what you look for, what MSCI looks for in their methodology when it comes to making a quality company?
Yeah, for sure. When you think about quality, I think when you ask a lot of portfolio managers, they always say, I invest in quality stocks. But when you ask one portfolio manager and another portfolio manager how they interpret quality, it could be very different. So the way we interpret quality, or the way that we define quality, is very specific, where we are screening for three specific metrics. We want high return on equity, so we want companies that are essentially winners. Stable year-over-year earnings growth, so we want not just winners, we want that stability as well. We want that consistency. And then we also have low financial leverage. And why low financial leverage is important is because you want to focus on companies that carry less debt, that have built their business more organically rather than through leverage. So I think why this is important is because during a rising interest rate environment, they're going to be less saddled by that debt. That that cost of carrying that debt is going to be less onerous for them. It's very interesting, I think, because when you look at investors like Warren Buffett, and you look at the metrics that he screens for, it's very similar to the quality metrics that we're looking for. So, as he says, by picking these metrics, you basically find companies that have what he defines as economic moats. So, screening for these companies, as you mentioned, you're essentially left with a lot of companies that have competitive advantages within their respective field. So we do have a number of quality ETFs available based on, US quality, Europe quality, and global quality as well. The global quality is a good solution, I think, for those investors that want a one-ticket solution to get, essentially the best blue chips in the world.
Yeah, for sure. And I like the way we offer the currency flexibility on the US option as well, and hedged, unhedged USD for ZUQ. So thank you for that. Now let's walk through this chart. Another chart from MSCI. It's showing quality relative to the parent index. Can you walk us through this in terms of what the quality variable, the impact that they have, basically?
Yeah, so as I mentioned, I think when you look at investing isn't necessarily a one-size-fits-all strategy, right? So certain people may gravitate towards certain factors that appeal to their investment objectives. So quality, some of the characteristics that quality offers is because we're focusing on companies that have stronger balance sheets, they tend to be less volatile because they tend to be able to generate a profit no matter what the economic environment is, and they tend to have competitive advantages where their earnings, that earnings variability tends to be a lot more stable. So as a reflection of that their stock price is going to be less volatile as well, because we're looking at companies with stronger balance sheets and stronger accounting metrics. We tend to avoid value traps, and last but not least, as I mentioned before, we're focusing on companies that have less financial leverage, so they're not focusing on debt. So theoretically, in a rising interest rate environment, these companies should fare better because they're not going to be as impacted by those rising rates.
Perfect. Yeah. And what are some examples of quality companies? I think we all know and recognize a lot of these.
Yeah, so this is a good illustration. I think it's a good illustration of the typical companies that you find in a quality portfolio. So essentially, you're getting a lot of blue chip names. I'm sure a lot of people recognize these logos already. It's not all the companies that you get in quality, but this is a little sample of what you're going to get through a quality portfolio or ETF. So names that you'll find here is Microsoft, Apple, Alphabet, Johnson & Johnson. All these logos here it's a good representation that they're leaders in their respective fields. But why I like quality, especially as a Canadian investor, is because I think it's very complementary to what you're going to find in the TSX. So you're going to get a lot of sectors that we don't have up here in Canada. So things like healthcare, consumer staples, consumer discretionary, also technology as well. But in addition to that, you're getting exposure to a lot of mega cap names that we don't have up here in Canada as well. So, when you combine that with the, traditional TSX, for example, you're getting, a much more well-rounded portfolio.
Yeah, a more complete portfolio. I definitely use a lot of these companies in my daily life, especially that Visa lately. Back to school shopping. So let's look at performance, because we all want to know, how has quality performed relative to the broad market?
So performance has been very good for quality, as you can see, versus the parent index or the market cap weighted index here. Over the long haul, quality does tend to outperform. So, when you think about it intuitively, you're focusing on companies that have, stronger balance sheets, more sound, economic financial statements. And as I mentioned before, because they have competitive advantages over the long haul, they're going to have stronger earnings over the long term. So that's going to be reflected in their stock prices. So what's interesting is that over the long haul, not only do they perform the parent index or have historically done so, but when you compare to the Morningstar peer group universe, so when you compare to the mutual fund and ETF universe that tends to be used in Morningstar universes, they tend to have very strong peer group performance as well.
Yeah, so outperformance with it looks like lower volatility as well. So that's great. Okay, so that covers off quality. Let's shift gears a little and talk about dividends as another area that we can consider when taking a blue chip investment approach. It's going to give you a little bit higher yield, of course. Walk us through the importance of dividends generally when it comes to portfolio construction.
I think when you look at Canadian investors, I think we have a natural tendency to gravitate towards dividends, and I think for very good reasons. I think this is a good illustration of that, where the orange line over here is the S&P 500 price return, so when you strip out the dividends. But the blue line is the total return, so that's when you include also the dividends as well. And over the long term, as you can see, that impact or the component that comes from dividends as part of your total returns is very meaningful. I mean, in 10 years, over 10 years, it's about 25%. But as you hold the securities or as you hold that index longer and longer, that dividend or that component of total return that comes from dividend is going to become more meaningful, as you can see from that 30-year and 40-year chart over there.
Absolutely, and I think dividends also have the benefit of just helping people stay invested, right? There's that psychological component of receiving that cash flow every month. All right, this sort of builds off of that, but walk us through what we're showing in these charts, Alfred.
Sure. So, when you think about dividends, I think it's very important to differentiate, companies that pay dividends. So just because a company pays a dividend doesn't mean that they're all created equally, right? So this is basically just a separation of different types of dividend payers. So there's dividend growers, meaning companies that have been able to grow their dividends over time. Dividend payers is essentially, companies that have kept their dividends flat. And then when you compare it to the broader markets of the TSX, and then you have dividend cutters and non-dividend payers. So, it's no surprise that the dividend growers and dividend payers tend to outperform because, again, when you think about this intuitively, companies that are able to keep their dividend payouts, or at least, or even better, grow their dividend payouts, they tend to have stronger financial positions. So they tend to be healthier from a financial perspective in order to raise their dividends. So as a reflection of that, their stock prices are going to, perform better over the long haul. So it's almost as if, we're still focusing on blue chips, but this is another way of, deriving those blue chip companies. In terms of volatility, same thing. When you see the dividend growers and dividend payers, they tend to be more stable over time, just because that dividend, as you mentioned, is a part of that total return. So every year, let's say if you have a company that pays a 5% dividend, you're starting every year with a 5% head start. But also because dividend growers and dividend payers, as I mentioned earlier, they typically tend to be more sound financial companies. So as a reflection of that, they're going to be less volatile than dividend cutters, for example.
Yeah, and one thing we often get warned about as investors is to avoid those yield traps, right? And that's why, as we always suggest, it's so important to look under the hood when you're evaluating different dividend methodologies and make sure that they're screening for sustainability and growth. So walk us through what we're showing here and some of the different methodologies that might be used and how that might affect the performance. And then I'll let you walk us through BMO's dividend approach as well.
Sure. So I think you raise a good point. I think, when you're looking at factor-based investing, so not just dividend-based ETFs, it's very important to look under the hood, so to speak. When you look at traditional market cap weighted indexes, I think the most important thing is tracking fees and how they're getting the exposure. But when you're looking at factor-based ETFs, how one ETF provider delivers that factor compared to another ETF provider is going to be very different, even though they're aiming to deliver a very similar outcome. The way that delivery or the way that screening process works is going to be very different. So some ETF providers, they basically just take all companies that pay a dividend. So as we showed in the previous slide, basically just focusing on companies that pay a dividend and then weight them by yield. So the danger in that is that if you have companies that tend to be yield traps, as you mentioned, companies that are paying a dividend that they can't sustain, you potentially fall into a yield trap, and eventually those companies will underperform. I think it's very important to look at companies that have a sustainable dividend yield, so have the cash flows to support those dividend payouts. So moving over to the next slide, this is essentially how we run our dividend methodology. So we start with the parent universe, so the traditional market cap weighted universe, so the Canadian universe for our Canadian dividends and so on and so forth. So that's our initial selection universe. What we do is we screen for companies that have had either positive 3-year dividend growth or at least a flat dividend growth. So essentially what we're doing is we're essentially cutting out those dividend cutters that tend to underperform over the long haul. And then we also look at the dividend sustainability. So we look at the dividend payout ratios versus their free cash flows. So essentially what we want to do there is we want to take a deeper look, not just blindly weighting companies just because they pay a high dividend. We want to make sure that those dividends are sustainable. So they're not just raising dividends for the sake of raising dividends. So again, I think this is a good way of capturing healthier companies and some of those higher quality blue chip companies that also pay a dividend as well. And then we weight these stocks based on their dividend yield.
Yeah, I think a lot of these companies, and we'll show on the next slide, are going to overlap with what are in the quality portfolios. But what you're going to get is that higher yield, right? I compared ZUQ's distribution yield, which is like 1%, to ZDY, which is about 2.7%. So you're going to get those quality companies, but you're also going to get that yield component as well. Okay, so walk us through some examples, Alfred, of dividend companies.
Sure. So as you mentioned, I think it is very similar names. I mean, Apple was in the quality name, Microsoft as well. So you're going to get blue chip companies in this, in our dividend ETFs as well. The key differentiation here is that they tend to pay dividends. So the way I would characterize it is, you're getting blue chip quality names in both portfolios, whereas your traditional quality is going to be a little bit more growth oriented because you're going to have some newer companies in there that don't necessarily, pay a dividend. Whereas in the dividend ETF, you're going to get, more mature dividend paying blue chip companies. So that's the main differentiation I would make between quality and dividends.
Perfect, thanks. And then to finish off, I just wanted to just quickly touch on our asset allocation ETF, BMO monthly income ETF. I think this is a nice solution for investors who are looking to get started or build a core portfolio around sort of a dividend approach. You'll see we've included here all the holdings in the portfolio, so heavily weighted to dividends. So I just wanted to point that out, available in USD as well. And I also wanted to highlight, because we get a lot of questions on this around dividend reinvestment and the DRIP plan, as it's called. We always get asked, are your ETFs eligible? So all of our ETFs are eligible for the DRIP plan. And it comes down to basically the broker or dealer that you're working with just turning it on. So what it is it means that instead of getting your distribution in cash, those dividends are actually going to be reinvested in new units. So if you don't need that cash flow, it's a really efficient way to just have it reinvested rather than having to build up that cash portion and buy more units. So I wanted to highlight that as well. But thanks, Alfred. That was great. Great discussion on blue chip investing. I think now we're going to turn over to our audience questions. So thanks again to everybody who keeps submitting these. You can submit these on etfmarketinsights.com. So Alfred, our first question that I'm going to turn to you on is, what is the outlook on interest rate increases over the next 6 months? Is there an ETF to hold which has little to no correlation with interest rate hikes?
I think that's the $1 million question. Everybody wants to know where interest rates are going. So the easy answer is that interest rates are going up. I think, without a doubt, with inflation where it is right now, there's an expectation that the Bank of Canada and the Fed are going to continue raising rates, as we saw this week, with another 75 basis point rate hike that follows up the massive 1% rate hike they did a couple of months ago. But the big question is, if inflation starts to turn over, we've seen, some evidence that it is starting to stall. The pace of interest rate hikes won't be as aggressive as the market anticipates. So I think, that's the main thing that investors are looking for. But in terms of an ETF to hold that is uncorrelated to, interest rates, I would say, global infrastructure, so listed infrastructure companies. ZGI, for example, which is our global infrastructure ETF, that's performed very well year to date. It's been uncorrelated to both bonds and equities. And another good thing about global infrastructure or listed infrastructure companies is that a lot of these infrastructure companies tend to have inflation built into the revenues as well. So that's another good reason to own, infrastructure or listed infrastructure in an inflationary environment.
Yeah, and we had an episode on infrastructure a couple weeks ago, so definitely check that out if you want more information on how that's a great solution for the current market environment. Okay, so the next question is, investors have been pouring dollars into US stocks away from overseas. Can we expect this to inflate the value of US stocks, at least temporarily? Your thoughts on that?
Yeah, I would say yes. I mean, that's the intent, or that's the hope of all investors. You essentially want to invest in assets where there's going to be money flowing into that stock or an asset class. So anytime you invest in US stocks, there's the hope that other money flow will follow, other investors will follow, but that is the intention. The big question is, as interest rates start going up and as fixed income starts to look more appealing, will investors start allocating more to fixed income relative to equities, and whether that's going to take away some of the flows away from areas like US equities.
Interesting. Okay. And the next question is, I want access to innovation-focused stocks, but I don't want all the volatility. Is there a solution that would be a good fit? So I can take this one, Alfred. So I would say NASDAQ would be a good solution to look at. And oddly enough, we're talking about that next week. So ZNQ, ZQQ, these ETFs track the NASDAQ 100 index. And it's really just going to give you a more diversified approach to all of these sort of future disruptors or innovative focused companies. It is 50% in tech. And one thing to note is that it actually has similar, a little higher, but similar volatility to the S&P 500 over the long term. So we'll be looking a little bit more at that, as I mentioned, next week. That caps off another great week of ETF Market Insights. So thanks everyone who tuned in this week, and thanks Alfred for your great insights around blue chip investing. Next Friday, I will be joined by Mark Merricks from NASDAQ and Mark Rays, our head of product at BMO ETFs. As I mentioned, we'll be talking about NASDAQ 100. So looking at these game changers, these forward thinkers, and all the companies that influence our daily lives across many, many areas. So I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.